the CPI inflation number for the month of January coming in higher than expected. The month-on-month increase has come in at 0.3. The expectation was it would be 0.2. The 12-month year-on-year full inflation was expected to come at 2.9. It's come at 3.1. Compared to, of course, 3.4 in December, it's better, but the expectation was it would be 2.9. The biggest culprit is home prices, shelter prices, which accounted for a 0.6% rise month on month and a 6% rise year on year. So that was the biggest component. What everyone would watch out for, including the Fed core CPI, that accelerated by 0.4%. Market was tolerant of 0.3. So even that's come in higher than expected. So the overall core inflation is still up 3.9% year on year. The expectation was 3.7 would have been acceptable. Now, what's immediately happened is all bets for a rate cut in March and May have moved back. May was still an expectation of 64%. Now the May rate cut falls to 36%. So clearly, the market has moved to June as the first rate cut. And more importantly, there were 6 rate cuts priced in calendar 24. It immediately has fallen to 3 rate cuts, which aligns itself with the dot plot of the Fed. The impact on the yields we've already seen. We saw the 10-year shoot up to 4.32, but the impact was also on the dollar. Dollar index at one point in time on 12th February, that is yesterday, for the United States, it was at 104. It leaped to 105 almost, 104.881, thereabouts. Now, what we will look forward to, this could be a one-day disappointment for the market because the US PPI number, Producer Price Index number, is due on Friday. And the PPI goes into the creation of the PCE, Personal Consumption Expenditure Index, which comes out on Jan 29th. Now, the CPI component in the personal consumption expenditure is what the Fed looks at. It doesn't look at the CPI. So, actually, this could be a one-day disappointment for the market. And if the PPI numbers were not as bad, then we could see the markets even bounce back. Impact on India itself, the 10-year bond yield has gone up to 7.14. With this, whatever gains we made because of the budget borrowing program being much lower than expected has been wiped out. We had fallen to 7.05 because of that. Now we are back to 7.1413 as I speak because of the expectation that as the Fed moves out, the RBI rate cut also moves out. Rupee hasn't weakened much from 83 to 83.10. It's not a great deal. That, of course, is, there's also the crude impact today. Crude's also higher as is the dollar, but this could be passing since the rupee is usually strong in the Jan-Feb-March quarter. There are lots of exporter inflows, and from June we are expecting the bond inflow, so not much impact on the rupee. Clearly, the biggest casualty in the Indian market are the equity markets, as we've already seen, because as US bonds become attractive, it's a risk-free return of 4.3 that you are getting. You are bound to see outflows from EMs and India. So that's what we are seeing just for the moment. But I think the overall positive should not be missed. The US economy is very strong. That means a stronger than expected world economy, and that can be only good for equities ultimately. Wrap up on